Hi, everyone. Thank you for tuning in to my new podcast. And Michael, thank you for taking the time to record today. Really appreciate it.
Yeah, happy to be here.
I want to start off with the first question. If you were appointed to Director of Bitcoin Strategy at Similar Scientific, what would your top priorities be?
I think number one priority is make sure the operating business generates cash and doesn't burn cash. Um, because if people think the operating business is a liability, then they won't focus on the Bitcoin strategy at all. So make sure that you have the operating business under control. Then I'd make sure I have a very clear communication of what the operating business looks like for the next 3 years. Because equity investors need to understand how much cash flow from the operating business is going to flow into Bitcoin. So when I look at the Bitcoin strategy, then, right, you've got a certain amount of Bitcoin. You're going to generate Bitcoin yield via sweeping operating cash flows. Then you're going to generate Bitcoin yield via selling equity to buy Bitcoin and issuing equity. And then the third way you're going to generate Bitcoin yield is by issuing Bitcoin-backed credit instruments. So if you're the head of Bitcoin strategy, right, the question that every equity investor has for you is how much yield do you expect to generate from operating cash flows? Under what circumstances will you sell the equity? Are you going to sell the equity at MNAV of 2 or better, 3 or better, 1.5 or better? Will you sell the equity at MNAV of 1 or better? Right. So giving some kind of clear guidance or setting expectations about how you're going to issue equity is important. And then the third issue is, so what's your credit strategy? Do you have one? Are you going to issue convertible bonds? Are you going to issue convertible preferred stock? Are you going to issue fixed preferred stock? So I would have a plan and be able to communicate the plan. And then I would start to execute on the plan.
I like that a lot. Do you think that Similar and other Bitcoin treasury companies should copy the structure of your preferred securities? Should they get creative and come up with their own preferred securities? How do you envision that playing out for other Bitcoin treasury companies?
I think if you're a Bitcoin treasury company, you should issue preferred securities. Um, I would I would probably skip all other forms of leverage. I don't think you should issue senior debt, junk bond debt, convertible debt. I wouldn't do asset-backed borrowing. I wouldn't pledge my Bitcoin for a loan. So most of those other forms of leverage I would skip unless you had a really good reason. I think that the ideal strategy for a Bitcoin treasury company is first you build a bunch of Bitcoin equity as much as you can. Um, and then when you get to a certain scale, you issue a convertible preferred equity like Strike. And then you issue a senior fixed preferred like Strife. And then maybe you issue a junior fixed preferred like Stride. I'm not going to say that all three of our securities are perfect, but they're pretty good. And they're the three most successful preferred equities in the century, like for 30 years. If you were to look around, you won't find a more successful preferred set of stocks in a decade or decades. So you would be going to top 1% just to copy them. So probably I would copy them. Why? Because if you copy them, then the investors already know how ours performed, and investors don't like to take unquantifiable novel new risk. Right? We've already blazed the trail. You're basically giving them what looks to be, I'm not going to say it's a sure thing because every single issuer is a different counterparty with different counterparty risks and different circumstances at different points in time. But what you are doing is giving them an understandable thing, like this is like Strike, or this is like Strife, or this is like Stride. So I think that's fairly straightforward. I think the issue is, an investment grade preferred, probably you ought to be targeting like a BTC rating of 10. And I think a convertible preferred, you ought to be targeting 5 or better. For a junk preferred, you could probably go to 3. Might even go to 2 or 3, depending upon the volatility of Bitcoin at the time that you issue the junk preferred. But that's what I'd be thinking. And of course, the limiting factor to all this is how much Bitcoin you have. So if you've got $1 billion of Bitcoin, you could probably create $100 million worth of investment grade Bitcoin credit. And you're going to be capped at that, right? If you have $10 billion of Bitcoin, you could create $1 billion of investment grade Bitcoin credit. You could create 2 billion of the mid grade, and you could create 3-4 billion worth of the junk grade credit. So you'll be in a balancing act, between raising equity capital. You can get more Bitcoin by issuing equity. You can get more Bitcoin by waiting for Bitcoin to appreciate. You can have more collateral by blowing away senior things in your capital structure. If you have a senior convertible note, equitize it. All of those are reasonable. And then, you're going to generate yield and generate gains by issuing BTC-backed credit. And the amount of gain you can generate is a function of how much credit can you issue and how fast.
Makes sense. I want to ask you about the long-term growth rate of Bitcoin and how you are thinking about that. Like I've seen you before suggest that maybe the long-term annual growth rate of Bitcoin might be something around 20%. I'm curious, like, how do you arrive at a figure like that? And I think also like that would suggest that Bitcoin would outperform the S&P 500 over the long run. I'm curious how you think about that in the context of the long-term growth rate of Bitcoin.
Yeah, well, I mean, you can look at the history, right? Bitcoin's been decelerating from 120% a year growth to 100% growth to 80%. It was clocking at 80, 90% when I got into it. It's been about 55 to 60% for the past 5 years. If you look at the rate, my forecast is it decelerates from 55% ARR down to 20% ARR over 20 years. Why is it decelerating? Well, obviously for the law of large numbers, when you've got $100 trillion asset, you're not going to grow 80% at that level. It's decelerating because it's merging with the capital markets, and as it merges with the capital markets, then there's less and less money. It's harder. It's harder. I mean, anybody knows $1 million company can grow faster than $1 billion company, which can grow faster than a $10 billion company, which can grow faster than a $100 billion company, which can grow faster than a $1 trillion company, which can go faster than a $10 trillion company, which can grow faster than a $100 trillion company, right? Not complicated. It's simply the law of large numbers and math. The 20% target is, if I look at it, if you want a bucket of the most high quality scarce capital in the world before Bitcoin was the S&P index. It's basically equity capital that's managed, via buybacks in order to stay reasonably scarce. And you know what that benchmark is. It's been about 10% a year for 100 years. Mm-hmm. Right? So what are you going to get from the S&P? 10 to 12%, 10, 13. The actual amount's going to be a function of the growth and in the equity plus the expansion of the money supply. I think that Bitcoin will outperform the S&P index. And I think it's very simple as to why it will outperform the S&P index. It doesn't have the counterparty risk of corporate structures. And it doesn't have currency exposure, right? So the S&P is saddled with a huge amount of corporate risk factors, dozens and dozens of them, tariff, supply chain, etc. It's got legal risk, it's got political risk, it's got physical risk. I have warehouses, I have nexus, I have an operation in Ukraine, I have, natural gas facilities in Iran, right? There are a lot of things in the real world that constitute risks in the S&P. If I strip away the physical risk, and if I strip away the political risk, and if I strip away the management risk, and then every company takes in cash flows and pesos and naira and euros and CNY and rubles and dollars and Canadian currency and AUD and whatever. So when you strip away all of those risk factors and keep the pure capital, you've got Bitcoin. So whatever those things are, Bitcoin will be more than that. How much more? Or like what is the cost of that? 6 to 8% a year. So if you're targeting the S&P at 12, you target Bitcoin at 18 to 20. Why will it be 18 to 20? I stripped away the risk factors. I also stripped away the constraints. For example, you cannot go long 50x on Apple stock on Sunday morning in Iran, right? You can't, right? We could talk about why you can't, but you just can't. So you can't go long and you cannot short an equity 20x on Sunday morning. So you have all of these guardrails on equity, and they limit the leverage, they limit the utility. If I had pure capital and I could have unlimited leverage, unlimited utility anywhere in the world, 24/7, 365, there are no holidays for Bitcoin, right? So what happens on a bank holiday to a security that you should short or you should go long? Well, you can't. Okay, so that bucket, that benchmark, which is the S&P, it's less volatile, it is less liquid, it is less useful, it is more risky, it is more diversified, and it's got some human factors in it too. I mean, the S&P board just decides what to put in it, right? Like maybe they don't put the right thing in, maybe they leave something that shouldn't be in it, right? So if you're looking for a pure objective monetary index governed by the laws of nature, the most useful type of capital asset in the world to everyone under all circumstances at all times, that's Bitcoin. So, if I were to say it ought to be twice as performant as the next best thing, that wouldn't be unreasonable. My forecast is it's probably 50% better, maybe 60, 70% better than the next best thing. So my long-term forecast is like 21% ARR and 21 vol. And I would say, the S&P will be more like 10% ARR, 15 vol. Bitcoin's going to have the higher Sharpe ratio. Bitcoin's going to have the higher vol. Bitcoin's going to have the higher performance because it's engineered and it's accessible. There's going to be someone in a country doing something with capital that you don't understand, that's illegal in your country, that's going to make you money, right? Right? The redneck in Arkansas with Bitcoin buried in their backyard is going to make money off of some rocket scientist in Singapore or Beijing doing something with some capital they've never heard of in a way they can't understand, that's either illegal, and they'll be doing it while the guy in Arkansas is sleeping. But the dude in Arkansas is making money. So this is the highest common denominator. Whereas, an American company that owns stuff in Arkansas is not getting its value increased by some Chinese actor, right? Or some, there's no nation state central banker that's going to do something to enhance your Arkansas strip mall or your whatever best idea. So that is the basis of my assumptions about the long-term performance of Bitcoin. Obviously, it's all driven by some base rate assumptions. One base rate assumption is how fast does the money supply expand? Another base rate assumption is how rapidly does technology improve and how much productivity is driven by technology. And if you're bearish on technology and if you believe inflation is going away, then you would probably have a lower estimate than me.
Yeah, no, that makes a lot of sense. So I guess would you say that in a way, Bitcoin is like a global productivity index fund to some extent?
It's a global monetary index, or you could say it's the greatest global investment index in the world. If you want to characterize as global productivity index, yeah, you could do it. If the world's more productive, that will flow into Bitcoin.
Hmm.
If the world inflates the currency supply, it'll flow into Bitcoin. If the world is more insecure, that should flow into Bitcoin, right? So it's being driven by chaos. It's being driven by order. It's being driven by conflict. It's being driven by the robots, right?
Yeah.
Eventually, if the robots do all the work and there's a trillion AIs in cyberspace doing the thinking and the cars drive themselves and a billion robots build all the robots and produce everything, there's going to be massive amount of equity value created for the companies that own the robots to build the robots. All that money is going to flow into Bitcoin.
Hmm. I agree. A hot topic recently has been the idea of MicroStrategy or strategy eventually qualifying or being included in the S&P 500. Do you think that, that might happen? Do you think that it's important if that happens? Is it overhyped? How are you thinking about that?
Yes, it might happen. The decision's above my pay grade. It'll be made by human beings, by a committee, and they may or may not make it whenever they may or may not decide. On the margin, I think the direction of travel is we will be incorporated into more and more indexes, and I think eventually we will be incorporated in the S&P 500. I don't know when, right? To the extent that the S&P 500 stays relevant, right? The risk for them is if they don't incorporate the innovative tech companies, then they become irrelevant and they underperform versus QQQ or some actively managed fund. So there's an incentive, but on the other hand, organizations have a degree of risk aversion and inertia to them, so some move faster than others. I think that maybe the salient point, which is interesting, is yesterday it came out that Vanguard is our biggest shareholder, 20 million shares of MSTR. And of course, Vanguard, it illustrates a lot of points. First of all, the CEO and the management team of Vanguard doesn't embrace crypto and doesn't embrace Bitcoin at all. But it doesn't matter what they think, because the funds they run are passively investing in this, whether they like it or not. And the whole premise of John Bogle and the Vanguard 500 was human decision making is inadequate compared to the market, and will generally be, the market is smarter than any individual's opinion anyway. So passive investing outperforms active investing most of the time, and Vanguard has lots of large passive funds. And once you understand that, you realize the core premise of a Bitcoin treasury company is we're driving Bitcoin adoption by capturing equity investors who can never by mandate buy a commodity. I mean, in our last presentation, we showed $35 trillion of discretionary capital for equity investors versus $700 billion of discretionary capital to invest in commodities, right? So that's 50x as much. So 50x as much capital can flow that way. Then Bitcoin treasury companies are creating an on-ramp for credit investors, right? Because there's $65 trillion of that we showed. So there's even more credit, not quite 100x as much, but 95 times as much capital to buy credit instruments as opposed to commodities. And then this Vanguard example, which is also the S&P example, is there's a set of investors that just park their capital in index funds. They don't make a decision. It's all passive capital. Passive capital locked up in the S&P or the NASDAQ 100 or the MSCI index or total stock market indexes, they can never buy the commodity. They can never buy Bitcoin. They can never buy silver, gold, or palladium. Doesn't matter how good it is. You could record 18 million hours of Bitcoin podcast. You could give away the Bitcoin for free. They're still never going to buy it, right? Because they can't. Because the capital markets in the world are structured. So we're benefiting from passive flows. We're benefiting from equity investors. We're benefiting from active credit investors. And we're benefiting from, this, I can't even name all the different types of capital that are locked up. The retirement accounts in the UK where you have control of the money, but you can only invest the money in a compliant equity that the retirement account lets you invest in. So there's lots of that, 401ks, IRAs, retirement accounts. They've got them all over the place. They've got them in Australia. They've got them in Japan. They've got them in the UK. And we're creating these instruments, whether they're equity or they're credit, to tap into those pools of capital. And it seems inevitable that passive capital will definitely drive this movement. The one thing that's worthwhile to note about Bitcoin treasury companies that's not true of other equities is Bitcoin treasury companies are pure energy creatures. We're absorbing capital every single day in the market. So if you're looking at my enterprise value, it's like tipping to 140 billion right now. The enterprise value of the company is 1.2 billion 4.5, 5 years ago. So if you were a passive investor, you might have had 1 billion of it. But of course, as we get 100x bigger, you're buying 100x more, and we're qualifying for a lot more indexes. And as we get indexed, that means that, when there are passive flows, and there are always passive flows, on the margin, there's always going to be more euros and more dollars flowing into passive capital markets funds. That's going to flow into the Bitcoin treasury companies and the index. And when that flows, it's going to drive their premium. And when the premium expands, then they can simply issue the equity, buy the Bitcoin, expand their equity market cap, expand their weighting in the indexes, rinse and repeat. And so BTC companies are positively polarized to the capital. They're magnetically attracting it. And I can't help but be amused by the fact that every major successful bank is upping their dividend and they're upping their buybacks. So they're surrendering capital to decrease their equity market cap. And then every well-run tech company is buying back their stock and issuing dividends to decrease their weighting in the indexes. So every well-run company running a traditional corporate finance playbook is surrendering capital as rapidly as they can. In fact, the more successful they are, the faster they surrender the capital, and the more they diminish their weighting in the passive funds. And then every BTC company is attracting capital, increasing their weighting in these funds, and thereby increasing their credit and equity premiums to the underlying assets, which is beneficial to all their investors. So there's a very positive cycle going on for Bitcoin treasury companies, and there's a very negative capital cycle going on for companies capitalized on traditional credit instruments.
Absolutely. If a Mag 7 tech stock came to you and were like, hey, we want to adopt Bitcoin, how would you recommend that they do it? Should they start slow and just deploy some of their cash into Bitcoin, or should they just go on a full Bitcoin standard immediately and issue fixed income instruments and buy Bitcoin as fast as possible?
If you're optimizing for economic results and you had a charismatic CEO, the CEO would say, we've embraced Bitcoin, we're switching to the Bitcoin standard. You would convert all of your discretionary cash to Bitcoin. You would cancel your dividend and make it a Bitcoin buy. You would cancel your buyback and make it a Bitcoin buy. Right? You would basically do everything that strategy has done. Then you would issue debt to buy Bitcoin. That's if you just wanted to make the money. And that assumes, like, who could do that? Well, Mark Zuckerberg could do that, right? If you have a very charismatic, powerful founder that has a controlling interest and isn't insecure about their position, they could do that. If they just wanted to make money. If you wanted to make $1 trillion at Facebook, that's what you would do. Or so at Meta. If you're more of an employee CEO and you don't have that much control, you would creep into it. We're going to take 5% of our assets and buy Bitcoin, test the markets, then you would increase it. And you would do all of this progressively over 3 to 5 years, building shareholder support and accommodating them, right? You wouldn't make as much money, but you'd still be better off. And then you would first test the investors. If they're enthusiastic, you would increase your allocation from 5% to 50%. Then you would, instead of raising the dividend, you would implement a Bitcoin buy. Right. And then instead of raising the buyback, you would implement a Bitcoin. So it would replace every bank, every Mag 7 stock announced an increase in a dividend, an increase in the buyback. You would replace the growth in those things with the Bitcoin program. That's a very incrementalist approach. You'd still make a lot of money. Not trillions. You wouldn't make $2, $3, $4, $5 trillion, but you would make billions or tens of billions, maybe hundreds of billions in time.
Yeah.
So that's what I would say. It all depends on who you're talking to. And the great irony with Bitcoin is the question is, who wants the money? Right? It's infinite money if you want the money, right? It's like, and some people want the money more than others. The irony is the best run companies in the world don't really want the money, right? They don't need it. The question is, do you want the money more than you want to be criticized or ridiculed? If you're willing to risk the ridicule or risk the volatility, you can have the money. But most successful money managers, most successful corporations, they don't want the money as much as they want stability and they want to avoid the risk. And so you have to find that rare combination. I don't think you're going to find it with, you're not going to find it with Berkshire Hathaway or the Mag 7 or the mega banks, because they're operating, as a pillar of stability. They've got a good thing. Arguably, the Mag 7 are the 7 greatest companies in the world. So if you have the 7 most powerful companies in the world out of 400 million companies, they're the 7 out of 400 million that least need Bitcoin. I mean, try the bottom 100 million companies. Pick every company in the S&P 500 below the rank of the first 10 that has no hope or chance of competing with the Mag 7. They have more upside, less downside. But it's always hard to predict who will grab an innovation and run with it. And sometimes it comes out of left field from someone that you didn't expect it from.
Makes sense. You touched on this a little bit earlier. How do you see the preferred and convertible markets evolving for MSTR? Are you pivoting away from convertible notes going forward and really going full in on the preferreds, or will you continue to do both here and there?
Yeah, I think we'll focus on preferreds. I think that preferreds are a much better source of leverage, and they attract more long-term capital, and they're more scalable. So I think you see. I think that that for a Bitcoin treasury company, if I was creating a Bitcoin treasury company from scratch, or I'm advising a Bitcoin treasury company, my advice is skip bank debt, skip securitized lending, borrowing, don't borrow against your Bitcoin, skip senior debt, skip junk bonds, skip the convertible bonds. If someone, I would go direct to the preferred market. I would issue a convertible preferred stock first, then a senior fixed income preferred stock second, then a junior fixed preferred third. And there are other things you could do, and we're exploring some of the other ideas, but what I just described is Strife, and Stride. It's right in front of you. You could just copy them. They're the three most successful preferreds in the century. Why wouldn't you just copy them? If you're a Bitcoin treasury company, you ought to be thinking, if I issue a preferred that's got a BTC rating of 10, it's investment grade. If I have $1 billion of Bitcoin, I can issue $100 million of that. If I issue a convertible preferred with a BTC rating of 5, it's pretty high quality. Maybe it's just one notch below investment grade. And if I am going to a BTC rating of 3, it's more like high yield or junk, or BTC rating of 2. It's like junk grade. And you have the option to issue things at any level there you want. When you do it, put an ATM on it, right? File a shelf registration, and then you're in the business of generating yield and generating BTC gain by issuing credit instruments in the capital markets, and your competitor is low quality bank preferreds, junk bonds, private credit, mortgage-backed securities, investment grade bonds, money markets, all of these things, corporate paper, right? Whatever it is, except your advantage is you can pay a higher yield and you can offer more collateralization.
If we go through another Bitcoin bear market similar to 2022, do you think MSTR and other Bitcoin treasury companies will go back to trading below 1x MNAV?
No, I don't think so. You can never be sure what'll happen, but first of all, I don't think we'll have a bear market like 2022. I think the only people that say that are the crypto bros, and the crypto bros are the ones that created the bear market of 2022. And they did it because they don't understand finance. And if I explain it in a nutshell, it's if you lever up yo-yo token 10 or 20 to 1, and in order to create a $10 billion FTT market cap. And then if you pledge $1 billion of yo-yo token and borrow Tether, and then you buy JoJo coin, and then if you lever that up 10 to 1, and then you take that and you buy Bitcoin with it, then at some point yo-yo token or JoJo coin collapses and you've got 100 to 1 leverage in the system. And by the way, and if you're silly enough to give someone $1 billion of loan, $1 billion loan with $800 million of JoJo coin or yo-yo token as collateral, like you're under collateralized to start, then you've just created this massive 100 to 1 leverage structure. And that's exactly what happened in 2022. Luna collapsed, FTT collapsed. You had all of these players that were under collateralized lenders and 100 to 1 lever, and they all got wiped out and bankrupted. What I'm describing there, you literally cannot do in the traditional finance system. Go to your bank and offer them $1 billion of Bitcoin and then try to get a loan. Now offer them $1 billion of Bitcoin and try to get a $1.5 billion loan. They'll literally laugh at you, right? Are you kidding me? You cannot leverage. All the Bitcoin treasury companies, they're not levered, right? They're like 80% equity and 20% convert, and the convert is almost always hedged when you sell $1 billion of the convertible arbitrager sold $750 million of your equity. So there's only $250 million out of, $5 billion that's actually in any way levered. So we don't have the leverage in the system that we had then. You can't even get the leverage in the system. Because as long as you're using, and I'm combining my comments to Bitcoin and traditional finance. I'm not talking about other tokens and other token treasury companies, right? Like if you capitalize on a token that's got built-in leverage, then yeah, you could have a rug pull and it could collapse on you. But if you just look at the Bitcoin ecosystem right now, for the most part, it's equity capital, and if there's any leverage, it's like MSTR might be 10% levered. Right? However you call it. During the 2021 run-up, you had companies that were, I'm not describing 1.1 leverage. That's what we might be. They were a 100x leverage. So there's a difference between 1.2 and 50 or 100. So I don't think you see that kind of volatility. I don't think you see that kind of drawdown. But having said it, Bitcoin comes back a bit. The premiums, they will fluctuate. Is it possible to create a Bitcoin treasury company that trades at a discount to NAV? Sure. I mean, if the operating business has debt on it, if the operating business is burning cash, if people lose confidence in the management team, if a $500 million company has the CEO announce he's giving himself a $300 million pay package, right? There are ways to crush the equity, right? Be irresponsible with regard to the way you run the business. It crushes the equity and you trade at a discount. But if you have a well-run Bitcoin treasury company, say you have $1 billion of Bitcoin and your equity trades to $900 million in equity value. What do? The logical thing you do is you issue $100 million of BTC 10 rated credit, investment grade credit like Strife, buy the stock back, right? Then, issue $200, $300, $400 million worth of junk credit like Stride and buy the stock back. So you issue preferreds and then you buy the stock, or you issue something like Strike, issue a convertible preferred with a 200% premium built into it and buy the equity back, right? The equity investors will look at that and they'll think, well, there's massive volatility, massive leverage. Why wouldn't I want to buy that? It's like I'm buying the senior 20% of the capital structure and I'm creating a short squeeze. So the real key to protecting the equity premium in a Bitcoin treasury company is building these BTC-backed credit instruments and getting them floating in the preferred market and attaching an ATM to them. If you have, the reason to do what I've described is offensive, because if you have a good BTC credit program, the MNAV could trade to 3, 4, 5, 6, 10. Right? I mean, you could trade at a massive multiple. Like, by the way, I'm just describing price to book. If you look at how you value a bank, they're like, oh, that trades at 2 times book value. Well, MNAV of 2 is 2 times book value for the company, right? So if you have the credit instruments, you create leverage, the equity will trade up. So it's offensive, but it's also defensive. If the shorts jump on you, how do you rip the faces off of the shorts? You sell the credit instruments, and like, what would you hope? You would hope that they would short you to 50%, of net asset value. You would sell 200 million worth of a junior preferred or a senior preferred, buy the stock back, and you're monetizing the discount. You're actually generating BTC yield buying the stock. And then you create a short squeeze. And as soon as you start to squeeze the shorts on that side, all the equity investors will jump on it and the options investors would jump on it and they'll rip their faces off. So you don't really have to be in fear if you're a financial engineer. You have $100 billion of Bitcoin. You're either trading at a premium and you're selling the equity, or you're trading at a discount and you're selling the credit, right? What shuts that down? If you can't sell the credit, right? If you've impaired, the reason that the company struggles is you've impaired the capital structure somehow by doing something stupid. But if you have unimpaired capital structure, if I have $100 billion of Bitcoin, I should in theory be able to sell 10, 20, 30, 40, $50 billion of credit at various rates, BTC 10, 5, 3, 2. When you do that, you either buy Bitcoin or you buy your own equity back, but you wouldn't have to buy that much equity back before. Like once you punch a bully in the face, like if the short seller gets to a certain level, once you slug them in the face, right, that they're not really in it for the pain. As far as I could see, there's really no intelligent investor who's a short seller. Like, for example, they don't have any courage. There's no one with $10 billion of capital saying, I'm willing to go short $10 billion and lose it all. Right. So you got a fund, the guy dabbles in it. He's like, I got a short, but no one wants to ride that one to infinity. They just don't have the courage. Right. So they'll skirmish with you for a bit. But at the end of the day, the winners in this market are people that have conviction and capital, and they're willing to look out a decade. And that's the advantage of the Bitcoin maximalist, right? Like we can go harder than anybody else. We can outlast anybody else. If you look at my best speech, by the way,
yeah,
I think my best speech is at the Atlas Society. If you go and you pull it, and if you look at me, I'm quite confident and comfortable and articulate, and I didn't have any concerns whatsoever. I think Bitcoin that night had crashed from 66,000 down to 19,000, and it was trading below 20,000. And I had friends in the audience said, yeah, you were so persuasive. I went and I bought Bitcoin that day. I felt like I didn't have enough. Well, we were buying it at 19,000, 18, 17, and 16,000. I was just as convicted then as I am now. I didn't feel any different, right? The shorts, they can't handle that, right? Their brains don't work that way, right? I mean, they're not acting from fundamentals or first principles. My view is just, well, it's pretty obvious Bitcoin's oversold due to the crypto leverage coming out of the system. That makes it less risky and a better buy today than it was at 50,000. Why wouldn't you buy more?
Yeah, that's a great point. That was a great speech. I'm curious to hear your perspective on this, actually. Is there any form of research or analysis on Bitcoin, computer science, economics that you've never read before, but you think someone should go out there and actually perform the research and do the analysis?
I think right now, people ought to be they ought to be focused upon generating a theory of BTC-backed equity and a theory of BTC-backed credit based on first principles in corporate finance, but then combine it with practical reviews of the equity capital markets and then the credit markets. When you start to look at the credit markets, you're struck with it's a bunch of under-collateralized, illiquid, poorly yielding, heterogeneous paper. And the big idea is, what if we convert 10% of it to Bitcoin-backed credit? And then how's that going to work out? And I think if you look at the equity markets, they're no different. But basically, the theory of equity is I'm valuing the equity based on future cash flows, a forecast of future fiat cash flows. And the theory of credit is I'm valuing the credit, I'm giving it a credit rating based upon forecast future cash flows. So the issuers of credit don't have any money, and the issuers of equity don't have any assets. And yet you've got the equity capital markets and the credit markets based upon investing in equity not backed by assets and credit not backed by assets. And I think that the big idea is to turn the world inside out and value equity based upon assets and asset growth rates, right? And value credit based upon the assets that back it. And you can probably, Joe, in theory, you can probably crank in the credit market rates, the cost of equity and the cost of debt or the cost of credit for any given capital market, and out would pop the fair or the rational equity premium that Bitcoin treasury companies should trade at. Right? Like what's a Meta Planet worth in the Tokyo market if the corporate credit rate is 50 basis points? If I think investment grade corporations pay 50 basis points for their debt in Tokyo, they pay 220 basis points for debt in Europe. They're paying 450 basis points or something for their debt in the US. If you start to actually, if you start to input credit rates and then consider, things like liquidity, volatility, of all these various markets, and if you look at equity, the equity returns, what's the cost of equity capital in Japan? What's the cost? Apparently, there really isn't any return on equity capital in Europe and in Japan right now. And the cost of, the return on equity capital in the US is sort of the S&P, right? Mm. You can probably develop an entire new theory of corporate finance that is rooted in statistics, financial theory, discounted cash flow, looking at the durations of all the instruments, and you can figure out what the range of equity multiple should be for a BTC company, or what the range of BTC multiples or MNAV multiples should be. And you can also figure out how much capital a BTC company can raise, and then how fast can it grow, right? And so there's some interesting theory there that I don't think anybody's done a scholarly piece of work on, but it's worth delving into. And the other point I'd make on that is I would approach that and I would grind the silicon on it. Like I would put ChatGPT into deep research mode. I would start to feed it all of the corporate finance textbooks. I would feed it all of the successful instruments of MSTR, right? We basically pulled out of the ether these things which never in the history of the world had been created. But in the history of the world, you never had Bitcoin as a digital scarcity to securitize. So no one ever created these perpetual preferreds. So no one ever could put an ATM on them. So you could never create the reflexivity, right? So it's like, creating turbocharged engines for the first time. It never been done before, but no one ever had the engineering to do it. So now we do, or the materials. You can't create a jet engine with balsa wood, clay, and ceramics either now, can you? So there are all these materials that you need. They're now in front of your face. We've proven the concept. The irony is, I would say to anybody, just copy us. And the more people that copy us, the better it is for us, the better it is for Bitcoin, the better it is for the world, and the better it is for the equity capital markets, and the better it is for the credit markets, and the better it is for the passive investors. Like, there's no losers here.
Yeah.
It's like we're just injecting steel, electricity, nuclear power, and semiconductors into the economy. Who's the loser? Just people that are prejudiced against those new ideas. But the world, I mean, the widows, the orphans, the pensioners, the passive investors, they're all winning. And so I think it's worthwhile to do that. I think we've proven it's possible, but we haven't sat down and reconceived the theory of corporate finance. The joke the joke is the academics will do it last. Joe, I'll tell you a funny vignette. It's Harvard. Everybody goes, well, we need a Harvard B School case study. Okay, I got one. The Harvard B School case study was written in like 2022.
Yeah.
Right? Like when we had achieved 10x return. Okay, it's totally out of date. The conclusion is company took some unwarranted crazy risk. It hasn't blown up in their face, but be careful, right? And 99 out of 100 Harvard B School students would say, well, we'd never do this. Even after you 10x your money, they would never do it. So 2 years later, they're like, okay, well, we're going to teach the case study again. It's 2024. I thought, oh, this is great. You're going to redo the case study? Oh no, we're just using the same case study from 2022. Like, huh? Really? We're 100x where we were? And here's the point. Sometimes they'll take 5, 6, 7, 10, people are teaching stuff that's 10 years out of date because it's a lot of work to redo it, right? I mean, and so everyone that thinks they know corporate finance learned from a textbook written 20 years ago that was 10 years out of date when they wrote it. And if it was me, I would reconceptualize the entire theory of corporate credit and the entire theory of corporate finance, right? Every best practice is a wrong practice, right? I just watched a parade of the best banks in the country. Every bank reports their results, and the news is increase their buyback, increase their dividend, increase their buyback, increase their dividend. And I wince and I think, these are banks that issue $20 of credit or $20 of loans for every dollar of equity. They're the last companies in the world that should be surrendering capital. And yet they're the most enthusiastic about doing it. Mm-hmm. Like you're 20 to 1 levered, you've got $20 billion of liabilities for $1 billion of equity, and you just made money, and your corporate finance idea is we're going to dividend it out and buy back the stock so that we're 40x levered. And it's painful.
Yeah.
And yet, theoretically, the greatest corporate financiers in the world are the CFOs of the Mag 7 and the big banks, right? Aren't they? I mean, like out of 100,000 corporate finance people, aren't the 20 best running the top 10 banks and the top 10 tech companies? And their practice, their playbook is increase the dividend, buy back the stock. Oh, do an expensive merger. Pay 20x revenue to buy some fast-growing company. So I know it's a long-winded answer to your question, but it's like reconceive corporate finance and write a new textbook. Like the Bitcoin standard, rethought the theory of money in a way. But what about the Bitcoin corporate standard rethink corporate finance in an era of digital capital? Because everything that you know is wrong, everything written is wrong, everything you've been taught is wrong, every case study is now irrelevant, and every action by the top 1,000 companies in the world is probably the wrong one, and they're enthusiastically pursuing them. So there's a big opportunity there.
Yeah, I think that would be a great idea. It kind of blows my mind that more academics and traditional finance types are not just fascinated by strategy's outperformance. It's after 5 years, it's fascinating.
I
One
would
more.
say it's probably more likely they're dismissive,
Yeah.
ignorant, or horrified. But
Yeah.
one of those three is probably the reaction of someone that's got 20 years of corporate finance experience that was well educated at Harvard, Yale, or Stanford. Most
Yeah.
likely, in my experience.
That makes sense to me. One more question, Michael, and then we can start to close it out. If Bitcoin adoption accelerates at a really rapid pace over the next 4 years or so, how different will the world look in 4 years from now?
We're not even 1%, so I don't know, maybe Bitcoin treasury companies will be 2, 3, 4% of the market. Maybe I think we'll just be the new interesting thing 4 years from now. Can we be
Hmm.
1, 2, 3% of credit? I mean, what does it take to become 2% of credit, Joe?
Yeah.
Right? Maybe there'll be a Bitcoin treasury company as one of the Mag 7. Maybe there'll be a Mag 9 or a Mag 10. Maybe there'll be one, right? Maybe this will be new. Maybe people will say, you know, Bitcoin will be an asset like it'll be viewed digital gold, right? If it's 20 trillion,
Yeah.
we're 10x from here. Okay, what does that mean? The world's the same as it is now. It's just Bitcoin is cooler than gold. Or it's not even cool. It may just be the new gold and the world is the same as it is now. And there's a lot of multi-billion, maybe there'll be three, four, five, $50 billion Bitcoin treasury companies. Maybe it'll be a few $100 billion Bitcoin treasury companies. Maybe it'll be $1 trillion Bitcoin treasury company, right? And everybody else will be doing their thing. And 5% of the B schools in the world will be teaching Bitcoin theory. And they'll be bragging about their innovative finance programs, and then half the other professors will be dismissing them as it's unproven, it doesn't have the track record of whatever, and we'll be getting around to it. That's what I think.
I like it. Well, Michael, thanks so much for taking the time to record. This has been incredible.
Yeah, my pleasure. Keep up the good work. Good luck
Thank
at
you.
similar.
Appreciate it.